Well, now it's time for our packet work, and we are on learning objectives 1 through 3. And the first learning objective was for us to describe retirement plans that are available to employees. So it's a time you might want to go back and review that slide that discussed the two retirement plans. We can either define what goes in, or we can define which goes out. And this is a description here. Lamont Corporation has a pension plan in which the corporation makes all the contributions, and employees will receive benefits based on the balance that is in their account. So when you read this, you can read that it is a defined contribution and not a defined benefit plan, because the employee's benefits are based on a balance in an account versus a particular formula which determines what they're going to be receiving. Now, it says this is a non-contributory plan when the corporation makes all the contributions, because the employees don't make contributions. If the employees made their contributions, it would be called a contributory plan. This is something we haven't discussed a lot, but it is something which it's a difference, another terminology for the plan. The most important thing I want you to be able to understand here is the difference between the two plans. You're either setting what goes in or you're setting what goes out. And those are the two differences. When we're talking about a PBO here, in Learning Objective 2, we are really talking about a plan in which we have established what the employee is going to be receiving. And this is the plan where we are taking on a tremendous amount of risk, because we are in effect guaranteeing the amount that an employee is going to receive so many years into the future. And this is when we have a PBO, because it is a defined benefit plan, not a defined contribution. So the accounting for a defined benefit plan will have a PBO in it. So now we're talking about the PBO, and there's a number of events, and you're going to think about how that might possibly affect the company's obligation or liability. And one event here is interest cost. What happens when you have interest cost? Well, we had a problem on that within the PowerPoints, and we said that interest cost would increase the obligation. And you calculate the interest based on the beginning balance, and you use this in your calculation. A decrease in the average life expectancy. This is often difficult for students to address, because they're thinking, well, if an employee doesn't live, that means they're going to be dying after they've passed the age of retirement. And if they die during retirement, don't they have beneficiaries? And don't the beneficiaries then get their retirement funds? And I'm going to say yes. But I don't want you to make it that complicated. I want you to think of the PBO as something that is for all employees, and we're not specific about when this employee is dying. We're just saying that on the average, our employees aren't living as long as they were living. It's unfortunate. It's kind of morbid to think about all these things, but if employees don't live as long, they can't work as long on average, right? And if they don't work as long on average, yeah, they get less retirement benefits, because a part of it is service years, and a part of that calculation of their annuity is also their final salary. So if they don't live that long, you kind of have to think about it in extremes. Maybe it's easier to see it that way. If they don't live that long, then their salary can't go up. If they don't live that long, then their service years can't go up. Both of these things tend to reduce the obligation, because they wouldn't receive as much benefits. Now, if 3 says you reduce the obligation, then you could also think about 4 If you increase the life expectancy of employees, that means that more of them are more likely to reach retirement age, and therefore they're able to, I want to say accrue, but have a greater benefit upon retirement. A plan amendment that increases benefits, and then they have this phrase, is made retroactive to prior years. Any plan that increases benefits increases the obligation. That's all you need to know there. An increase in the discount rate. This is a tricky one because when you take present value calculations and you increase interest rates or discount rates, what it happens here is it decreases the obligation. You kind of have to think about this thing in present value terms as going backwards or the reverse. Benefits are paid to retired employees. Whenever you pay, you don't have to pay them in the future. It's less that you have to pay those particular employees in the future. I would say that I would caution you a little bit on this one though, because while employees are retiring, what's going to happen? We're going to have to probably replace those retired employees with new hires who will then be working, and we are then going to increase our obligation with the new hires. So if you just think about paying the current employees who are retiring, yes, it does reduce the obligation. But if you're talking about employees retiring, you're going to have to replace those workers with new workers. So the short answer is it does reduce the obligation, but if you look at the total picture, you're going to have to replace the workers, which is going to increase your obligation for the new workers. Service cost was a line item, and we went through that calculation. Any additional years an employee works, usually in these defined benefit plans, because of the way it's calculated, will increase the obligation because it increases the annuity payments. Clark Industries has a defined benefit pension plan that specifies annual retirement benefits, and it is defined, and the way it's defined is by a formula. We said defined means you can get to a number. It doesn't mean the number is exact, but you can think of a number or you can get to that estimate. The way they calculate is 1.2 times service years times final year's salary. Over to the left it says PBO calculations, ABO calculations. Well, all you need to know in this class is PBO calculations, because PBO calculations are GAAP. ABO calculations are not GAAP at all. So using PBO calculations, you would take 1.2% times the number of years that they have worked at this particular balance sheet date, and then you put in an estimate of their final year's salary. Stanley Mills was hired by Clark at the beginning of 1997. You're going to start your timeline. You're going to make a hash mark at 1997. And then you're going to go out to 2016, because if you read in the third line, that's our balance sheet date at the end of 2016. And then if you go out, another hash mark is going to be the end of 2041, because that's after working 45 years and when they're going to retire. The final hash mark is going to be 15 years beyond that date, which is when they are going to get their last retirement check, their last annuity payment. So do it as a timeline. And remember, when they say they are hired during a year, in this case 1997, they're usually going to start at the beginning. However, when they talk about the retirement time, or they talk about the other times along the way, the balance sheet date, they're talking about the end of the period. So when you subtract, remember that you have to add 1 to get the number of times between these hash marks. Okay, so 20 years after they're being hired, their salary is $80,000. That's not going to be the relevant amount, though, when we do our PBO calculation. That's going to be $270,000. Our first step is to think about what the annuity amounts are going to be. That's 1.2 times 20 times 270,000, or $64,800 a year. A lot of times students will tell me that's an awful lot of money. But then after they get out and they start their jobs working in accounting and they make the big bucks because they're accounting majors and they made it through this class, well, they're going to see $64,800 isn't really that much. But they also get Social Security payments on top of this. So we have $64,800, that's the annuity payments. We are going to make the present value calculations to get back to retirement, and that is retirement. So at retirement date, how much will they have? You're going to calculate $64,800, take the present value of an annuity 15 years at 7%, and get the figure for the calculation what the PBO should be at the day he retires. It's $590,193. That's not the relevant number though. We need to go back to the balance sheet date, which is the end of 2016. To do that, you do the PV of 1 for those years, and you come up with $108,743. That's the value of the PBO for one employee. You would want to do this for all your employees. Would you go in and do the calculations for each individual employee? No. What would probably happen is you would classify, the actuary would think about all the particular characteristics of the employees, classify them somehow, and think about their life expectancies, whether they're likely to leave and go to another job, what they think their ending salaries will be, maybe based on what their current position is. They would make a lot of calculations and come up with some number which would reflect all of their current employees. Now, what will happen is if there were absolutely no changes, which is just really ridiculous to assume, but if there were no changes, we kept the same employees and everything, we had like a crystal ball and everything was perfect in our calculations, we would get a PBO at the end at this retirement date for this particular employee, or for all our employees for that matter, based on the value at the date of retirement. For this employee, it would be $590,193. If we had a crystal ball, we don't have the crystal ball. This is just kind of conjecture, right? So what would happen if we went another year? If we went another year, you would be moving your first hash mark, and so you're not in 2016, you're at 2017, which means the difference between 2017 and your retirement date is going to be narrowed, right? So that the PV of 1 calculation, the number of years is going to change. The other thing to think about is the service years. The service years will change, the present value calculations will change, and the annuity is going to change because the service year numbers of service years goes into the calculation of that annuity. So everything changes, and you have to do new present value calculations every year to come up with the new numbers. The two major things that will change is there'll be another service year added, and we call that service cost, and also the effect of present value calculations, and we'll call that interest or interest cost. So service cost, the annuity in the future goes up, and you're discounting that, and then also you're calculating interest based on the beginning balance of that PBO. Now, the last bit of this is discussing the difference between ABO and PBO, and ABO uses existing compensation levels. So the 1.2 5% times service years is taken then times their current compensation level. That's ABO. Now that is not the way they would be paid. They're going to be paid based on an estimate of their future salary. And so therefore, using ABO calculations, which doesn't use future salary but use existing compensation, is not GAAP. We are going to always use PBO in here. How does a PBO change other than for a service year or interest costs? You know, the first two, of course, is service cost and interest accrued on PBO balance, and we're told to exclude those two that I've listed here. But any change in the plan, and you could come up with so many different changes in the plan. Change interest rate. Change the number of employees that are eligible for benefits. Those would be plan changes or retroactive adjustments to plans, okay? That's three right there. The actual payment of the benefits, how many years they need to work before they can retire or are eligible for it. Changes in any kind of estimate related to the employee. Are they going to leave? What percentage of employees are going to leave employment? The life expectancy, we've discussed that. So there's so many different events here. It's easy to come up with 5. Now this final one down here is kind of an introduction to the next day 2 PowerPoints and day 2 of pension plan accounting, because this is called a walk forward, and a walk forward means starting someplace and ending up somewhere else, and we're talking about balances in accounts. So at the beginning of the year we had a PBO balance of 80 million, and at the end of the year we have 85 million. Remember, this is a liability. And the two primary reasons why our PBO would go up are service cost and interest cost. Service cost, because another year has been worked, and interest is interest calculated on beginning balance, which is 5% here or 4. And if we reduce our PBO because we pay out benefits, that shows up here as a negative. Somehow when we did this calculation though, and we had 80, we added 10, we had 4, we subtract 6, we come up with 88, and we have actually in our balance 85. So there's something which happened in between that caused our balance or our liability to go down by 3. And that's the only way we can make the account what we call walk. In other words, start at one point, end up at another. The only way you can put this together to start at 80 and come up with 85 is if you were to subtract 3. We are going to call this adjustment factor required in PBO to be a gain or a loss. Now, since it's a negative number, and it's a reduction in a liability, it is a gain. Now, usually when you see these things and you are looking at an asset and you see it as a reduction, you say, well, that's a loss. But this is something which reduced the liability. It's a good thing because it reduced the liability. And the reduction in the liability is $3 million. So we're going to call it a gain. The next set of PowerPoints is going to describe in greater detail these walk forwards, how we do the walk forwards, and the relationship between the accounts which you have when you have defined benefit plans.